Hi, can you hear me, Tomas?
Hi, I can hear you.
Perfect, perfect, perfect. Um, Thank you so much for coming. I'll just let people kind of sign in a little bit. I'll just give it a minute. Hi, George. Thank you for coming.
Hi, good morning, and welcome back from vacation.
Oh man, rock and roll. Yeah. Like got a lot of stuff to go through. But I have to say thank you, Tomas. You like spent a lot of time and energy writing down some really helpful feedback to how I present um, my service. How I explain to people um, not only like what kind of stocks to buy, but really make it easier for people to kind of use this, because for a lot of people, they kind of they're busy, and also there are different people. There are people that are kind of been investing for a long time, they're retired, they have all the time in the world, and there are other people that are kind of still trying to figure out about investing, and just trying to make it easy for everybody, because there's a lot of competition everywhere. And I'm hoping that I'm going to be able to deliver something that is worthwhile. So anyway, the way I've decided to do this is I'm going to talk for about 15 minutes. I'm just going to go through 15 minutes and talk about like 3 stocks that I feel that are worthwhile buying right now. And then I kind of open it up. And if other people want to kind of say, oh, Michael, what do you think about this? What do you think about that? And if I see that there's nobody really wanting to ask any questions, I kind of have some other stuff that I can add to the end as well. So the way I'm going to do this is at the start of each month, approximately the first week, top 3 stocks that I can say, okay, these are stocks that you can buy right now. And then the following few weeks, I'm going to talk about some kind of key topics like diversification, portfolio management, and I'm going to also sprinkle it in with some kind of how to think about a business, like just going back to some basics, because some people are beginners and other people more advanced. But some people just kind of not really sure what's important to look at, and I want to kind of say, okay, look at the 10K, look at these aspects of the 10K, just to make it so simple and intuitive, because when people start investing, they're kind of all interested, and some habits you lose over time. But it's really, really important, because it's when the market is up, and everyone's making money, it doesn't really matter anything. But when the market is sideways or down, putting in that practice is really, really what's going to pay the return when things are working out well. Okay, so without further ado, stock number 1 is Gear Cloud Technologies. Is a stock that I understand why it's cheap. It's cheap because it comes with this kind of quote unquote label of being a Chinese company. I get it, right? It's like it was based in China, and Chinese stocks, nobody wants to invest. I get it, trade, whatever, blah, blah, blah. So it's kind of like that. But why I'm interested in this business is that they are coming away from being a China-centric business, and they're trying to relabel themselves as a US business. So they're kind of going through changing their accounting from IFRS to GAAP accounting, just to be squeaky clean. They're moving their headquarters over to the US. So I feel that this is I'm kind of joking a little bit when I'm saying this, but it's like a bit like PDD. I don't know if some people will know this name, some people will not, but PDD used to have this. It was just basically like a wannabe Alibaba, and people didn't really want to get involved with, blah, blah. And it was just doing so much better than Alibaba that after a long time, it got its own version of the story, and that takes some time. And now, obviously, in the US, PDD also has VEMU, it's VEMU. So it's kind of like, you know, it's changed that label away from it. And when you change from a foreign company to a US company, sometimes you get a bit of a premium on the stock. Now, I also know that this is not always the case, because I have seen companies that used to be foreign companies, they go over and they try and be a US company, and it doesn't always work. And I can also highlight cases, for example, everybody knows Constellation Software, Canadian company, and that does pretty well, compounding over time, really, really well. And, you know, that's not a US company. So this US label doesn't always guarantee anything, but, you know, it's a small cap, and it helps being a small cap. Market cap is about 900 million. Being a small cap company, it helps if people perceive it as being a safe company. So they are a logistics company that for the transportation of bulky items. So it's not really like just shipping like little bits of merchandise. It's like bulky items. But what they try to do that is different from other people is they try and use a lot more technology. So they don't have as many warehouse employees. And that incidentally is why the stock kind of there was a short on the stock. People were short the stock because it was like, if you compare the best logistic companies like Amazon, DHP, and other companies, per employee, it looked like it was a scam, or it could still, you know, every business can be a scam. You know, Tesla could be a scam. No one really knows until after the fact. But it looked like there was too few employees for the revenue that they were making. So there was question marks on this. But what I like about this company is that they're growing at approximately 40%, kind of 40-45%. So it's a fast growing business, but they also acquired a bankrupt company, and as they're acquiring this, you get a boost of inorganic growth. So it was like, you remember with Broadcom, they made a large acquisition, and when Broadcom acquired VWware, it like boosts that the stock and obviously the returns, because the performance looks better. It was like that that natural gas company Oki that I had. That's that kind of it's a dividend company, so it's not really the same. But when you get this boost, I try and buy into and recommend companies that have very clean balance sheets, because for a very, very clean balance sheet, it kind of gives you a bit of flexibility. And it never really matters about having this flexibility until it matters, meaning that when when the market kind of gets a bit tighter, and you know the credit's a bit, it's more difficult to raise capital, having a clean balance sheet gives you just tremendous ability. And in this case, they went and acquired a bankrupt company. So when you look at their guidance for Q4, because they only give quarterly guidance, when you look at the guidance for Q4, it looks like it's like very, very strong, like 70%. But they say, you know, that's a large portion, that is the inorganic growth from the acquisition that they've made. So Giga Cloud Technologies, that's company one. The other company is a company that I like, and it's HIMS and HERS. And you know, I've been recommending this stock for a long time, and it hasn't been a very strong performer. And you know, they haven't really done anything wrong. So as succinctly as possible, I like this business because I believe that over this coming year, they're going to grow at approximately 40% compounded. And so a business that is growing at 40%, it shouldn't really be maximizing the free cash flow that it makes. And people kind of get infatuated with the idea of the mega caps and how much free cash flow they make, and look at the multiple on that. But a business that is growing, as long as it's not burning cash, as long as it's being prudent with the investments that they're making, you can get a reasonably strong return by just holding on to that company, provided that the multiple doesn't compress. That being said, HIMS' multiple compressed significantly because interest rates were going up, and I don't know if you guys know, but in 2023, it wasn't towards the end it did become, but the majority of 2023, the returns of the market were quite narrowly focused on like the mega caps, and it wasn't the broad. Towards the end it did become, but it was very much concentrated on like the top of the market. And HIMS, because the small cap, it's still kind of there's the verdict out whether it's able to grow and be profitable, because there's a question mark whether they're spending too much on SG&A to acquire subscribers. So they're acquiring subscribers at quite a rapid rate. The latest figures, I think it's around the paid subscribers are up 55% year over year. But obviously some of those subscribers churn out now. As they churn out, at this moment in time, more of them are coming in. So as long as you have more coming in than going out, things are also mean all good. But the business is already profitable, and I estimate that it's priced at approximately 30 times free cash flow. Now, as I said already, 30 times free cash flow may sound like a rich multiple, and I understand that. But if the business is growing at a rapid rate, provided that you have this little check and balance that has a clean balance sheet, which HIMS has no debt, provided that, it's making some free cash flow, they can use that free cash flow either as they did in the past year to make some acquisitions, or to just reinvest into having better executive team. Now, the final business I want to talk about is the one that I recommended yesterday, Samsara. The ticket is IOT, kind of like Internet of Things, IoT. The reason why I like this business is that I am mindful that at this moment in time, a lot of things are working favorably in tech, and I'm mindful about that, and I don't want all my eggs being in tech. But at the same time, I recognize that this business, I believe, is going to increase the profitability by about 500 basis points, or 5%, compared to last year. So they're going to grow, and they're going to be probably somewhere in the ballpark of 6% operating margins. So if the business is able to grow, which this is my thesis, if the business is able to grow at approximately 35%, that's what I'm hoping to see, 35, 38 maybe. If the business is able to grow like that, and I can see by the number of customers that they have, that is still quite close to around 50% year-over-year growth in customers, in paid customers. Like a lot of these software businesses, the higher quality customers that spend $1 million on the platform are growing faster. This is quite common in enterprise, and the kind of large mass, which only pays $100,000 for access to the platform, are growing ever so slightly slow. So I've taken a slower figure, and at the slower figure, it's kind of growing approximately 40%, 40, 45, something like that. The last quarter was 49, but I've added some margin of safety to think that it will slow down, because, as it does. So if you get customers paying 100,000, growing at 40% year over year, obviously in this example, keeping pricing relatively the same, so the revenue is also growing approximately 35, 38, something like that, percent year over year. So if you're getting some growth there, provided that the multiple doesn't significantly change, compress, you know, by and by, you kind of should get a 30% return over the course of a year. That's just common sense, right? Now, I feel that if you think about it, if you're getting a business that is increasingly profitable, the multiple should remain relatively the same or even expand slightly. But I have not priced in any expansion. I just thought myself, okay, if the business is able to grow at about 35%, and it's going to be more profitable because I feel that the operating margin will be about 6%. If it's able to grow and be more profitable, it'll be better perceived in the market as more stable and more predictable. And if you get those things happening, then people would be willing to pay more for the business, particularly if the business continues to grow over time. So that are the 5 stocks that I kind of wanted to highlight. I've managed to do it in 15 minutes, which I'm quite happy about. It's a lot to take in, and I kind of open it up, if anyone wants to ask me like a couple of questions, and we'll see how it goes.
I have a question about, have you looked, I want to ask about insider buying. Is that something that you look at before you buy a stock? Is how much ownership the heads of a company have? I mean, what factor is that to you?
So I think you may or may not be talking about Open Door.
I'm any stock actually.
That's right. So, I don't know if you know, but one of the best stocks in the world was Apple, and Steve Jobs didn't actually own a lot of Apple, and that would have kept a lot of people out of the stock. When he got fired from Apple, he sold his ownership, and why he became a billionaire was from he owned Pixar, and Pixar was bought up by Disney. So that is just an anecdote. And the market has a way of offering up a lot of what I call distractor information. And there's, in investing, it's very easy, particularly nowadays, to get access to a lot of data. There's a lot of data thrown at you, like inside the buy, inside the sell, or so-and-so litigation. It's like there's like so much things. But what drives the share price higher is the increase in intrinsic value of the company. Now, that just sounds like a mouthful, but the increase in intrinsic value is directly related to the increase in sustainable profitability. So if I was just to simplify that even further, the share price will over time align with the increase in earnings. So let's just boil it down to like the variables as much as possible. It's really about share price goes up and it aligns with increase in earnings. Just to make it a tiny bit more complicated, the confidence that investors have in the increase in earnings. Okay, so hypothetically, Microsoft will grow its earnings a little bit or a lot, and people have a lot of confidence that increase in earnings is going to happen next year, the year after that, and that's why people pay a large multiple. That makes sense, and that's how it goes. That's how the share price goes up over time, is the confidence that people have, or another word could be expectations that people have. Now, if another company comes along and they have like a blockbuster period, and people don't really know the stamina of those increased earnings. So, for example, during the COVID period, there was a lot of work from home stocks that did really, really well. But even as they were reporting really strong results and earnings, the share price was already tickling down. Obviously, you could say the bubble had popped, but I'm just giving you an example that sometimes earnings are really strong, and you see that the share price just kind of peters out, and that's just telling you, okay, people don't have a lot of confidence that the earnings will continue to increase. So I'm coming back to your question. I don't look when I'm buying a stock whether people have been buying or selling. Sometimes I like to, I'm human, and I kind of like to see as well what's happening. When possible, I like to align myself with stocks that have a large amount of insider ownership. For example, HIMS. I don't know how much is still owned, but management when I was kind of recommending it held about 35% of the stock. It may have come down to, let's say, I don't know, like maybe 30%, maybe 25, something like that. I haven't checked because the proxy only gets reported in April. But I believe it'll be around that. So if the market cap is, let's say, for round numbers, 2 billion, that means management has 500 million worth of stock in the company. So they are like really, really motivated. The same could be said about Uploving, that case as well. But sometimes, you buy into the stock, and with Open Door, the CEO is kind of selling the stock, and you feel like, oh man, that sucks. Like I bought into your vision, and you are leaving the company, and I get that, But then I say to myself, Tesla, Elon Musk has been selling the stock for a really long time, and that has not stopped the stock from just basically going over into the moon. So I'm trying as best as possible to think about what are going to be the earnings of Open Door or another company next year. I'm just trying to think, okay, at the end of 2024, when the investor thinks about this company, what are they going to be looking at the next 12 months? And I spend a lot of time on doing that. And whether the CEO was selling the stock now, it won't matter to that shareholder next year. It matters to now, but it won't matter to next year. But what's going to drive my return is next year, what the people are going to believe next year. Now, I don't I'm a bit like you. I kind of get, I'm anxious to make money, and, I don't want to hold forever. I don't want to have those lazy longs. But I also know, I recommended Open Door when the stock was $8. $8, man. And that was a mistake. That was a mistake. I should not have done that. But I watched that share price go from $8 to 79 cents. Man, that killed me. Like, it just absolutely obliterated me. But it sucked. I recommended 8. It saw it for more than 90%. It killed me. But I looked like a few days ago, it was like $3. So, okay, yeah, it has come a lot. Okay, it's very far away from a penny stock, but the verdict is still out. It's not, but I do buy this company. I buy this. I buy the share price. I buy the stock from time to time, and I can stay here and be proud of myself because I had a lot of doubts in myself, and I had a lot of people writing to me and saying unkind things to me. But I feel like, okay, yeah, now I got return. I got my return as well. So when I come on these calls, I always say, you can try to be as smart as you want, or you can try to make money, but you need to know what you're trying to do in the market. I'm really trying my best to make a living. I don't it doesn't matter how smart you are, because at the end of the year, when everyone's kind of counting up and all the news is talking about, oh, S&P has done this and S&P has done that, and I'm like, okay, how have I done? And if I've done better, I feel like, okay, good for you. And if I haven't done better, I'm like, what do I need to learn? And with I feel like, yeah, there was a time when it was scary for Open Door, but I don't think that is the time. I don't think that is now. And I'm not immune, and I resonate when the share price is not working out, and I see that. But I also know that there are times when you just kind of leave things and give them just a few weeks, and things kind of settle down, and you don't know until sometime later, right? And you having to kind of stay there and grit your teeth, and but I do think that looking at insider purchases, in my opinion, or insider sales, in my opinion, is a distraction. But if you allow me, I'll just say momentarily one thing. So another stock that I owned and I own is Enovix. And Enovix, when I was kind of buying, I was like, okay, it's a pre-revenue business, so they haven't got any revenues. I was kind of hoping that they would get some at the end of 2024, but I wouldn't know yet. We'll see. But anyway, when I was recommending the stock, I did feel okay. The founder of Enovix used to be turned around Enphase, and when which is to do with energy solutions, and when the founder was buying a lot of the stock, he was buying like several millions at a time of the stock at the same price that I was buying at. So I was like, okay, like I don't know if he's gonna be a serial entrepreneur. I don't know if it's gonna work out favorably, but this person is buying millions in the shares in the stock that I'm buying. So I'm like, okay, I'm hoping. So I don't base my decision on whether people are buying or selling stock, but I do think quite hard about what the business is going to be doing in 12 months. That's really like what
Thank
I'm
you.
really trying to do. Yeah. Would anyone else like to ask any questions? Okay. If no one else asks, I'll fill the time with some thoughts that I've had. In the market right now, as I said already a few times, I recognize very well that tech is working extremely well. I get it, and tech is a great thing to invest in because it sells itself. It's kind of like the CEO is a charmer, and they come on and they speak their lingo, and they're like, oh, and everything is hunky dory, and the share price is going up, and everyone's singing and dancing, and it always sounds so futuristic and great, and it's working, and it's I get it, but I also know that it can move down again on a dime, and I know that some report from somewhere comes up, oh, inflation is back, or the Fed has said this or something, and all of a sudden people move away from these risk assets, and they kind of they don't want to invest in those kind of high growth assets. So I want to keep some diversification in the portfolio, even things that are not really working out, like now, like Antero Resources, which is natural gas. I kind of want to keep those things because I know that when things are not working in tech, as they will at some point, I know this, and I've seen how these share prices just melt. They kind of down day after day, like 10%, 10%, 10%, and you kind of like, oh my God, like, and I want staying power. So when I try to invest, I am trying my best to have staying power, because what you don't want to happen is you might not know it until later, but all your stocks are actually more aligned than you believe they were, and everything melts down, and you have you get really nervous and anxious, and you end up selling stuff at the wrong time. So having these kind of commodity stocks, they're priced like a value stock, and they're really quite they're really cheap, so they kind of work the indirectly to, let's say, the long duration assets like tech stocks. So when interest rates change or something, people move away and they rotate out of tech, and I don't want to have all my baskets in that. And for some people, they don't want that. Some people just want no diversification, just want to be invested in tech, and I understand that. But I also I've been through that cycle, and I've learned. And if I go through these cycles and I have those drawdowns and I haven't learned anything, man, like, what's the point? Why do I bother to get up in the morning? I get up in the morning to grow as an investor. And I hope that through my experience, I'm able to speak to you and say, okay, this is what I've learned. So you don't have to do that mistake, because it's okay to learn a lot by yourself, but it's also okay to learn vicariously from other people's experience. And I want to become a better investor, and it kind of works two ways, to be honest, because the more that I learn and I'm able to quote unquote teach and educate and recommend, I'm also learning as well alongside, because I see where I have faults in my own thought process. Yeah. Kind of put it out there if anyone wants to kind of ask any questions or anything. Yeah.
Hi, Michael.
Hiya.
Hi. So, well, I do favor tech stocks. So I want to know, aside from tech stocks, what would be the number 2 sector that or industry that you would put your place your bets on?
Yeah. So I George will know, and Tomas that come here quite often, they'll know that I really like uranium. The stock that I recommend.
Uranium. Okay, okay.
The stock that I recommend is UEC, and I said already before that I don't like it when it's really complicated, the thesis, and it's like, oh, you got to think about this and that and the other. It's really a very straightforward thesis. The idea here is that when uranium stays stably above about $60, the businesses that the uranium miners can start to resume production. Now, a uranium mine has a lot of risk aspects, so it's not like, say, like a coal mine that you can just get up and going in like tomorrow morning. There's a bit of time that it takes, because you need to hire people, and there's a lot of safety stuff, so it takes time to kind of get there. But I honestly believe that a lot of miners are going to start mining for uranium. I'll just, like, in 1 or 2 minutes, I don't know if you know, but I'll just kind of 1 or 2 minutes explain the idea behind uranium. Just humor me. I'll just, like, I don't know if you know, but I'll just kind of go through it quickly. So the world to move needs energy, and there's a lot of push towards moving away from fossil fuels. The main energy source of fossil fuels is oil, but the world is trying to cut back from this, from using energy from fossil fuels. So there are 3 avenues that you can go. You can either go and build a lot of green energy, and I'll come and explain that in a minute. And you can also use natural gas, and you can use uranium. Now, the problem with green energy is that it's not very reliable. I'm not anti-green or whatever, but I'm just saying the facts, right? The facts are you need energy in a city, and you can't really make a lot of solar panels or wind turbines in the middle of the city. You can put it somewhere else, but then you have a storage problem. So I'm not saying that uranium is the only way, but it's one way to resolve our energy problems. It releases no carbon. It has the problem with the disposition of uranium once it is spent, so that's a question mark. But you can get a lot, like so much energy out of uranium. So I'm not saying that it's going to be like the one and only solution, but I do believe very strongly that as long as uranium price stays above 60, now it's at 90, as long as it stays around this price, UEC shareholders, which is Uranium Energy Corp shareholders, will benefit from that, because it's unhedged, has no debt. It's not the only uranium company. There are other uranium companies, but I kind of like this one because it has no debt, has some assets. They're very entrepreneurial. Now, I'll be honest. Amir, who's the CEO of Uranium Energy Corp, he's highly over promotional, and it's a bit like Elon Musk, he kind of a love-hate situation. But, ultimately, for the period of time the company UEC has been around, it's been a bear market. It's been a bear market in uranium for about 12 years. So for 12 years, like, the company couldn't produce because it was unprofitable, it was uneconomic. Now, finally, the price of uranium is relatively high, that they're able to start at some point soon productions. Yeah, so that's the one company that I like outside of just pure play tech. Another stock that I also like, and you can see that on the spreadsheet, is Builders First Source. I like this. It's basically like a lumber distributor. So it has nothing to do with kind of like just random commodities. It's very much about the lumber price, which kind of is tied to demand for housing. It is not
Yeah.
it's not the only way to get exposure to demand for housing, but it is one way. And the price of the stock is about 9 times earnings, more or less. And they are repurchasing aggressively their share count. I've been recommending this stock for coming now close to 2 years. They've been aggressively repurchasing their stock. So do it's on the service. Do check out Builders First Source and do check out Uranium Energy Corp. Those are two stocks that I feel like that they're quite good outside of tech.
Okay. Thank you.
Sure. Does anyone else want to ask any questions? No? Okay then, people. I would like to say thank you so much for coming. I really appreciate it. I hope I'm really determined this year to work really, really hard. I'm going to make some difficult decisions in kind of, I don't want the portfolio to be like 25 stocks. I need to be quite brutal and trim things that are not working. I know that for some types of investors in my marketplace, that's really what they love. They love like buying and selling. Other people like to kind of just make one decision, buy and then forget. And you're never going to please everybody. But I know from experience that at the end of the year, when it comes to count up the money, it makes a difference, the work that I put in. So you're never going to please everybody in life, and that's just how it goes. But I'm going to be absolutely determined to be fully transparent and tell you, okay, this is working, this is not, and and shuffle things around. Yeah, okay. I would like to say thank you so much, everyone, and I hope to see you soon. Thank you.
Thank you, Michael.
Thank you.
Thank you, Michael.
Thank you so much.
Thanks, Michael.
Thank you. Bye.